related question. In that regard, you can ask stocks, options, futures. You got a question? Give us a call. Of course, you guys know the call-in number is 877-927-6648. We had quite a lot of callers last week. Probably didn't get to all the callers last week, so if you guys have questions, by all means. And when I say questions, you got a stock you're thinking about, putting a trade on, whether it be bullish, bearish. We'll talk about specific option trades in regards to any underlying equity index product, even some of the commodities out there which have kind of been in play as of lately here. But again, give us a call, 877-927-6648, because it's a really long options hour if you don't call. All right, so let's go over the markets, talk a little bit about what we see in terms of markets here, obviously after the long weekend, and returning to that here. So ES futures up, of course. That's the S&P 500 futures up about 6 right now. NASDAQ futures up over 20. It's been kind of the strength in the markets here. Bonds are actually up very, very nominally here today. We're going to talk about that in just a moment. The other thing that really kind of stands out on my screen is, of course, the VIX being up. Interesting. The VIX is up when the market is up, and that's really kind of the initial segment that I'm going to discuss here this morning. In fact, a couple of you guys emailed me, specifically, James Jim emailed me. It's one of the guys in the den here that listens, obviously, quite often here to the Options Hour, but thank you guys for emailing me. Everybody is pointing out what I've been watching all morning, and that is, of course, the VIX is up, what the markets are up, and also that's also going to relate to, of course, bonds. TLT is pretty much flat on the day. TBT also kind of flat on the day. Oil is actually off the highs of the day. So let us talk a little bit about the markets, and then, of course, we'll jump to the first caller here. But if you guys are thinking about calling us, give us a call at 877-927-6648. One of the things I saw early this morning is if you guys were up and watching the market before the market opened, I say that. Listen, there's callers from all over the country here. I'm actually residing in Scottsdale, Arizona, so I'm on West Coast time right now. And when I am on West Coast time, I always wake up. I'm usually up 5:45. I have a baby. We don't sleep in at my house. And when I was, futures were up about 12.50 this morning. That is, the ES futures were up about 12.50. NASDAQ futures were a little higher than they are right now. Actually at the 25 half level, and as we opened, the VIX actually opened very, very slightly up on the day, and which was kind of an interesting indication. You don't see that on a day-to-day basis over here, where the VIX is up and the market's up, obviously meaning somebody out there is buying puts, or puts are being bid up, and that's really going to be kind of the theme throughout the day. Isn't necessarily just this one thing. It's not necessarily, hey, the VIX is up but the market's up, but it's more about tape reading, okay, and looking at some of the relationships that exist in the marketplace. Anyway, with that, I'm going to jump to our first caller. We've got Kevin from New Jersey. Got a question about the VIX. Kevin, you there?
Yes, I am, Don.
Yeah, how you doing?
Okay, good. My question is for the VIX. You said last week to use the VIX to our advantage for calendar spreads.
Sure.
And if you could clear up some on how that works, I'm still foggy on that.
Sure. So, ultimately, when I say utilize the VIX, and that's obviously to gauge S&P 500 volatility, to use it to your advantage is, for the most part, calendar spreads make you net long volatility. So for the most part, when you buy calendar spreads, it makes you long volatility. So when would you want to get long volatility? Obviously, when volatility was at a relatively low level in comparison to where it had been, let's say, in the last 3 months, 6 months, or even, a year in terms of time frame. Currently, the VIX is on the relative low side, okay, to where it has traded over the last, couple of months. And you look back a few years, and obviously the VIX has been much higher. The average for the VIX, going back quite a few years now, is closer to about 23. Obviously, the VIX at 16, this might not be a bad time to be a net buyer of volatility. Now, that being said, it doesn't mean just be long calendar spreads in here.
Okay, because of the summertime now that people are backing off, and there's a good chance the market's probably going to start heading south, would be a good time to take advantage of the VIX, is what you're saying?
So that's that's the exact right question to be asking. So if you believe the market is going to sell off and sell off hard, it means you believe volatility is going to rise. What's interesting is, since I've been in this business, a lot of traders, old school traders I work with, always say the market never goes anywhere in the summer. But since I've been in this business, my first year of trading was 98. It was insane in 98 because of the fall of long-term capital. 99, the markets were, on fire. 2000, 2001, like every year the summer has held pretty heavy volatility. So, I am a believer that, traders, they don't go away because it's the summer necessarily. But, yeah, I agree with you also your statement that if you think the market's going to sell off here, for sure, be long out of the money put calendars are going to give you the best bang for your buck in a major index product if you think volatility is going to rise up.
Okay, good. Thank you very much. I have one more question.
Yeah,
if you have time.
Go for
you did a seminar last Thursday, I believe, on TOS on Vega.
Yep.
And I called in to see if that was going to be archived, and they said that they didn't know.
We so rarely archive things anymore. It's the fun of doing a chat on the platform over there. But these are. So, that one on Vega is not. But you know what? I repeat this stuff time and time again. So be sure to keep kind of tuning in. And ultimately, we just talked about here in the last 2 minutes really summed up a lot about Vega for the most part, is, how to utilize volatility in really, Vega itself can be a profit source. Like people seem to always think that, hey, you can only make money if the market goes up, if the market goes down, but you can also take positions that don't take a lot of directional risk, but you can take a stance on volatility and purely volatility plays. And that was really just try to open up your mind to the fact that people make money purely off Theta and off Vega, but it's not something that the retail world typically looks at.
Right. All right, well, thank you very much. I really appreciate it. I wish I could hear that 2 more times, the Vega. But
you know what?
Excellent seminar.
I'm going to do another chat. I want to say the 8th and the 9th of June on ThinkorSwim. It's during the trading day. I'm going to do those swim lessons on there, and it's going to be all about analytics, but there'll be a ton about volatility and Vega in there for sure.
Right. Can you tell me real quick, I have the Greeks down pretty well.
Yeah.
In the last 8 months, I guess, after 4 years of doing this.
Yeah.
I spend all day doing this. This is what I do now. I'm semi-retired. I'm having a problem with one Greek, and I'm sure you know which one it is.
You got some gamma issues?
Yes.
Gamma issues. Everybody has gamma issues. So
I have gamma, and can I just clear up and say that just hypothetically, if you have a calendar spread on, both 20 on XYZ stock, and they're both at the 20 strike price, September and June, if the stock is at $19.20 and it starts to head up towards $20 on your June, that your gamma is going to kick in to the point where it's going to kick in faster in June than it will in September, to where that you could actually lose money on a calendar because the strike price is increasing in value, that option for that strike price in June.
Right. So the
quicker
gamma,
than the value of the September.
All right. So the confusion is this. The gamma curvature is the rate of change of delta, but still, if the at-the-money option, becomes the 20. So if the stock is at 20, you have a 20 strike. So the 20 basically is the at-the-money option, and all of a sudden that option is at the money. Either way, regardless of what gamma is, your delta is still going to be 0.50. And that's actually what we're thinking about in terms of calendar spreads, is you want your delta to be 0.50 if it's a calendar spread, because it means that's the at-the-money option. And the at-the-money option, regardless, is always going to carry the most time value. And time value is ultimately how the calendar spread really makes money. So if you think about this, if you watch your gamma growing. And if you take large option positions and you take a look at them, you'll always notice an option position that's positive theta, meaning positive time decay, always has, okay, inversely a negative gamma associated with it. The larger the negative gamma, okay, also the larger you're going to have a positive theta. So if that calendar spread starts to mature a little bit and the calendar spread really becomes the at the money, you'll see your theta offsetting a lot of the directional risk incurred in that particular trade. But don't really view gamma as a bad thing. Like negative gamma is never really a bad thing until you start to get to the last like 3 or 4 days of an expiration cycle, because what it does is gamma ultimately starts whipping your delta around to an uncontrollable fashion. And that's really the only key component.
Compared to your long position, like say if you had a September, that's not going to affect gamma because it's so far out.
Correct. So it doesn't matter, though. Still, the delta will change to about 0.50 in the September options, but okay, you're going to get the most time value in the September options, and June is still going to burn almost completely away. So having a gamma that's high on a calendar spread is actually a good thing because it's meaning you're burning a lot of theta in your favor at that time.
Oh, okay. All right.
Yep. And also,
all right, well, thank you very much. You answered my questions, and I really appreciate the information.
Yeah, absolutely. Sounds great. Yeah, thanks a lot. All right, no problem. So, we started off with a bang there. We're talking about gamma and of course theta and your Greeks. And you know what? I love questions like that because so rarely do we get a lot of retail clients that not only ask questions in regards to some of the Greeks, the option Greeks, but really on a call-in show like this, I love that kind of stuff. So, hey, if you've got questions about your Greek position, call in. We'll talk a little bit about your Greek position because, very few clients ever go over to the monitor tab and go, hey, what is this, the delta? My delta is negative 100. My theta is positive $7 and change. What does that even mean? And looking at your Greeks is really taking a look at your position from a 50,000-foot view. But professionals in this industry, that's how they monitor their risk. All right? A lot of clients, they monitor their risk by looking at what's my profit and loss from the open, what's my profit and loss from the day. But what these don't tell you, hey, look, P&L is absolutely important. That's why you're in this business. Okay, but P&L does not discern what your risk is right now, and it definitely doesn't discern what your risk is in the future, but that's what the Greeks do. For the most part, if you understand your delta, gamma, theta, you can see your risk right now. I can see my risk if the market rallies up $1, down $1, up $2, down $2, really anywhere the markets move, and you can kind of gauge, risk in that regard. So with that, if you are thinking about us giving us a call, you should, because the number here is 877-927-6648. Talk to us about the Greeks. Ask us questions in regards to your option trades, your futures trades, your commodity trades. With that, I am going to jump to our next caller. We got Richard in California, portfolio enhancement question. You there, Richard?
Hey, Don. Yeah, good to talk to you. So yeah. Heard your show about portfolio enhancements and went out and when the spiders were about 132.
Okay.
I sold the 134 calls and bought the 136 calls. Okay. So the question is, now I'm sitting here, it's not clear to me, is this kind of an all or nothing thing? I let this run and some months I win, some months I lose, or do I try and fix things if they seem to be going the wrong way for me?
You know what? I get this question a lot. So you're right now, you're in a June, you got 17 days left, you're at a 34-36 spread, right?
Yeah,
okay?
Exactly.
The spread itself is obviously in the money by about 23 cents. You're fine because ultimately, if you think about it, we were at 132. We've got to rally all the way to 136 and change, okay, or just over 136 for you to take a full loss on the spread. But the reality is, remember that it's an enhancement. If we go to 136, whatever portfolio you're trying to enhance is obviously up some money. Okay, so that's kind of a key component of this is as we rally up, okay, for the most part, as we rally up, your portfolio is actually gaining alpha. It's actually increasing in value, where the enhancement itself is just there to obviously not only enhance but reduce some of the downside risk here. With 17 days to go, I wouldn't even bother looking at it. Really, this strategy is bang it out, close the trade about 4 to 10 calendar days prior to expiration, kind of win, lose, or draw. If your spread is losing like yours is right now, in fact, your spread really isn't losing right now. You sold a 134, 136 June spread. We're about 19 cents in the money. I mean, for the most part, again, that spread's not losing, but it's sitting there at almost like a break-even point. Yeah, you're absolutely fine. So the market has actually rallied up. Your spread's at about break-even now. You couldn't ask for more.
Okay, cool.
Yeah.
And the other question, here's the other question is, I like the underlying, which is SPRD, okay? I'm bullish on it. I think it's going to go up. So I went out and I sold the 18 puts, the June 18s, I sold the June 19s and bought the June 18s.
Okay.
Okay, and so...
what is this called? Spread trim?
Like spread trim, yeah.
Spread trim. I've not heard of this one. Every time I do one of these shows, somebody calls in, I'm like, what the hell is this? I like it.
It's one of the IBD 50 stocks.
All right.
So the question is, same kind of question. It's not. Can you go through some of your thinking? Like, how do you know when you need to get in there and try and fix this, get out of it? I kind of put this thing on, and I sit there, and I never know what action to take or when it's okay to just let it run.
All right, so you sold a June 1918 put spread, right?
Yeah. Okay,
first question I've got for you. Why'd you sell it? Do you want to get long stock here, or you just want to sell a put spread and try to basically make a couple of bucks in the put spread?
I just want to make a couple of bucks. I think the stock was going to go up to like 22, so I just wanted to, make a little extra money there.
Then at this point, you're fine. Sit tight. I would actually use a closing window, to actually close this trade as well. And that is, for the most part, you sold this dollar-wide spread. I mean, this is not one I'm all that familiar with, but I'm going to guess you collected anywhere from, 40, 50 cents on this thing? Do you know what you collected?
Yeah, it looks like, about a little over, right around 45, I think.
Okay, so I'm taking a guess. So the spread right now is trading for about 35 cents. It's obviously not that exciting and profitable yet. It's only a $1 wide spread. Two different ways you can close this. You can close this spread if you can buy back the short options, or you can buy back the entire spread, okay, for, about 10% of the width of the strike. So the width of the strike is $1, right? So 10% of that is, if you could buy the spread back for, 10 cents or even 5 cents, buy it back. Otherwise, try to close the entire trade out, in that same closing window of about 4 to 10 calendar days prior to expiration. Ultimately, let's say the thing does go against you. There's no real fix for it. I mean, the spread only has, for you, if you sold a dollar-wide spread for a 45-cent credit, spread only has 55 cents of risk. So for the most part, letting it go, you're risking about 55 cents to be able to make 45 cents. Probability of success is good on this. There's no reason that you should panic on this spread at all early, and just try to let the trade work for you.
Okay, well, thanks a lot, Don. I've been trading stocks a long time, but I'm just starting into options, and I'm listening to everything you're putting out there. It's really helpful. So thanks.
No, this is you're fine on the spread. This is exactly the kind of questions too, because you're pinned on this position right now. I mean, we're at 19. You're selling the 19 put. And this is exactly where people panic, only to see the trade turn around and have gone your direction right after you closed it,
Yeah. Okay, so, thanks, Don.
All right, thank you for calling in. All right, so kind of moving along here on the day. What we started talking about the day is in regards to the facts that the market is up and the VIX is up, and that's actually fading a little bit. So let's talk a little bit about kind of tape reading, get a couple of callers coming in here. Again, if you are thinking about asking us a question, you should call us at 877-927-6648. And you know what? I love when people just call up and you've got a stock, you're thinking about putting something on it. What is something? I don't know. You could be bullish, you could be bearish, you want to look for a neutral trade. We'll go through all of them. You call out the stock and we'll try to find bullish, bearish, neutral. Hey, but remember, try to make sure the stock is relatively liquid here, because in trading options, liquidity is your best friend. So with that, let's kind of jump back to what I started with this morning. Excuse me, and that is the fact that the futures were up. this morning. Early on the open, futures were up 12.5 right at the open. They even rallied a little higher than that throughout the day. And then the futures proceeded to sell off a bit. And as these futures had rallied up, the VIX was, and it still is, slightly elevated on the day. So that's kind of an unusual circumstance. You don't see that on a day-to-day basis. But this is kind of what we call a little bit about tape reading. This is really what traders and former market makers have always looked at for years. All right, so you've got the market up and the VIX up. So what does that really mean? Well, ultimately, when you look at the VIX being up, it means that there's possibly some risk coming into the marketplace. For the VIX to be up, that is typically indicative, okay, of put buyers. So someone out there in the market bidding up and or buying puts. All right, when I say bidding up, they're literally buying puts. Puts themselves are getting bid up. That's what the VIX basically increasing is about. So you can't just look at the VIX and go, oh, the VIX is up and the market's up. That's not good enough. Is there anything else on this screen that would confirm, all right, there's possible risk in the marketplace? And the answer is, well, yes. If you took a look at bonds this morning, before the open, the markets are up, okay, and bond markets were actually down considerably, meaning that, this bond market over here, and I can look at bonds in several different ways, this bond market right here at the ZBZN was actually, okay, down on the morning. So bonds, okay, can be utilized as a flight to quality when there is fear in the marketplace. The bonds being down on the day is typically a bullish sentiment. And if you saw the market open here, you can also, by the way, if you don't read into bonds, you can look at TLT and TBT. All of a sudden, after this market here, and you'll see the high on the day here of TLT was 96.66. All right, so it was up actually, just a little bit here on the day, but the low of the day was almost $96, okay, even. So the bond itself was actually down on the day, which is also kind of a confirmation. The bond being down on the day is actually confirmation of a rally. And again, at the market open, the bonds turned around and kind of took off to the upside. In fact, the bonds are trading flat to slightly up right now, which is also, again, kind of a flight to quality. There's a little bit of fear in the marketplace. So ultimately, a lot of people are sitting here looking at the exact same thing, and you're thinking to yourself, oh my gosh, somebody knows something. Yeah, and that somebody is not you. So the reality is, keep your eyes open, okay, on tape reading a little bit more than just staring blindly at a chart on the spiders of the S&P looking at a 1 minute. It helps to understand how to read into these marketplaces. Other interesting things this morning is the Euro-U.S. dollar. That's actually retraced the big move from earlier today. You also look at like oil. Oil is backed off, is at a high of 103.39 on the day. So again, a lot of different things to keep your eyes on today, and we'll talk about some specific underlyings. Of course, give us a call at 877-927-6648. I am going to jump to our next caller. We got Mark in Portland, Oregon. He's got a question about gamma scalping. You there with us, Mark?
Yes. How you doing?
Yeah.
I have been experimenting with gamma scalping and been doing it with the ES options on futures.
Okay, no problem. Yeah.
The reason why I chose that is because obviously you get the terrific leverage with it. But my question for you is, I know this is a strategy it's a little more complicated because you really have to watch it. But as I understand it, the way that you study the Greeks on this is that you look for a situation where you're expecting a big move and you expect volatility to be going up, and that's the situation you should be buying into a straddle in this case.
Sure. So you're actually going in there to the ES options, buying like an at-the-money, for instance, a June straddle there in the ES options?
Yes. Well, what I did, which was a little bit lower risk, is that I took some the last couple of weeks I've been doing it on the weekly options after they've been pretty much sold off.
Okay.
Trying to catch them at a low point so that my risk is a little bit lower.
Okay. Volatility will have really almost no effect on those particular options, on the weekly options. With very little time left, Vega means absolutely nothing. So, in the classic sense of gamma scalping can be profitable in numerous ways. You can get large moves and increases in volatility. When you buy that straddle, all you're doing is basically hedging the straddle back to delta neutral every time a big move has happened. whereby scalping, off chunks of your trade as you're moving forward. But again, the shorter time frame that you're utilizing, Vega is going to have little or no definitive, movement on your portfolio in that regard. So kind of keep that in mind. Vega kind of extract a little bit from that equation. But so gamma scalping is interesting only because, you know what, I haven't heard any clients talking about gamma scalping, and it's been years since I've talked about it. And market makers have done some form of gamma scalping in one form or another also for quite a few years. There are two primary types of gamma scalping, too. You can gamma scalp from the long side or you can gamma scalp from the short side. And more often than not, I actually see a lot of people gamma scalping short options now, which means they're either selling a straddle or selling a strangle, and then basically, leveraging that as positive theta and trying to keep the deltas relatively under control. So I got to ask, you're buying the straddle. Are you trading ES actual contracts against it? Are you trading futures contracts against it, or are you just chunking out pieces of the straddle as we move?
What I typically do is that I'll buy a straddle 10 contracts each way, and then when the ES moves up, I'll take profits on whichever direction it goes.
Okay, so you're chunking off the actual straddle itself.
I'm chunking off the straddle.
Yep. Okay. No, that's a form of it too. So there's a lot of people that that prefer that. When you trade real size, you actually use the underlying against the straddle itself. So as you rally, as the straddle, for instance, you have the straddle on. As the market were to rally up, you can sell a future to help neutralize some of the directional risk incurred, whereby locking in some profits. But you're always, of course, fighting theta decay in that. That being said, trading and gamma scalping, it's interesting you mentioned the weeklies, because that is when the gamma curvature is going to help you the most, is during those weekly options. So, that you definitely keyed in on. If you get a big move while you're gamma scalping weekly options, you can be really profitable. The one thing you need is movement, and you need it fast as can possibly be to offset any of that time decay you're going to get eaten alive on.
Yeah, I had one time where I gamma scalped right before the close, and overnight we had a big move, and woke up in the morning with a really nice present. So I got me excited about doing it more. But then I've had a couple of other times where it's just sort of grinded away on me. So
no, it's awesome. It's been years since I've actually gamma scalped myself. I mean, as well as I do, when you gamma scalp, you got to sit in front of that computer. I mean, you literally have to sit in front of the computer and shave off part of the straddle as we go. And it's a great strategy. And I remember when I used to gamma scalp in the past, it was like every single night I would watch the futures, and I'm like, oh, please, world, come to an end right now, because, I need it for this straddle to offset some of the risk in there. But no, I like it. It's another thing I haven't heard from in quite a while.
Yeah. Okay. Good. Well, so the thing I'm just clarifying then about Vega. I look at this now. I have a pretty low Vega on this particular straddle I'm on right now, and so what you would really want. What you're saying is that volatility changes don't affect it that much, because it's too close when you're doing it on weeklies, because it's too close to the expiration.
Right, and you can even, if you're on ThinkorSwim and you pull up like the ES options and options on the futures, if you take a look at like Vega, the physical Vega, if you actually pull that up in the information layouts, you got Vega right now of the at-the-money options on the weeklies of 55 cents. And what that basically means is vol moves 1 full point up or down. Like vol right now is, like 16%. Vol moves up to 17%. The most you're going to make is 55 cents. It's just not a huge effect. You get a little bit of bang for your buck. Like if you have a straddle on here, yeah, you might make like, 50, 60, even 70 cents for a 1 point move in vol. But you're really going to need like an earth-shattering move for the volatility to really pay off. And the closer you get to the expiration cycle, the less the Vega is going to matter. If you were to look at like the June options, they've got 17 days left in the June options, and those things have, $1.18 of Vega. Then you go all the way out to the July, and they've got almost $2 of Vega for every, 1 point move in volatility. And all I'm trying to say is that Vega just isn't, a huge portion of it. If you've read about gamma scalping, and it sounds like you picked this up from a book, or did you just learn it from other traders?
Actually, I've a number of places. I've heard you mentioned it indirectly in the past. I've read it in a few places, and I actually sort of just, before I knew what it was, I thought it was just buying a straddle. You know, I didn't know the term. But so when I heard you mention the gamma issue, and I thought, okay, well, how do I spot a trade like this? Am I looking at something with a high gamma? And of course, then that's what led me towards weeklies, because you've got this terrific gamma reading on a weekly option, and the theta is much lower there, so you feel like you're risking a little bit less on time decay.
Yeah, no, you know what? So I totally agree with your perspective on gamma. I mean, literally, expiration week has always been known as gamma week. So you've got the best gamma, the bang for your buck. But you know, Vega, which is always mentioned, it is mentioned in gamma scalping all the time. The Vega risk. The reason I was asking, did you read about it, is because in the last time I remember anything being printed about, you know, gamma scalping has probably been years ago, and they didn't even have weekly options at that point. So Vega is a much bigger component when you have a monthly option. But in these weeklies, it doesn't really matter. I mean, the burn is so fast right now. What you need, though, in gamma scalping, and taking a look at those front month options, is you either need drastic moves, okay, in one direction or the other, or you need basically movement back and forth. All right, so the VIX where it is right now isn't, you know, it isn't bad for gamma scalping. It also isn't the greatest. You know, there's a lot of perception that the higher VIX has always been better for gamma scalping, but a higher VIX then causes you to have to pay considerably more for the straddle. Okay, and if volatility does go down, that could have a little bit of a negative effect on here. But the bottom line is all you need is fast movement here, and it typically should be a good trade. I got one other question for you, too. Do you buy the straddle before the week before, meaning like do you buy the straddle on a Thursday or Friday, or do you actually wait to the Monday after the weekend to gamma scalp?
Well, what I discovered, I woke up or logged on right after the markets opened yesterday, and the price was terrific. Actually, I bought a strangle yesterday, not a straddle, just because of where the ES was. But it looks like from what I've experimented with so far, the best time is to buy after a weekend, because everything has been beaten down so badly. The straddles have been beaten down so badly over the weekend that when you buy first thing on a Monday morning, you've got a little bit of a window where the time decay is not going to be so bad.
Yeah, that's exactly kind of what I was getting at. Is I'm like, are you buying the time before or after? Because I mean, if it was myself, I'd look to Monday, you know, mid-morning to be able to buy that strangle or straddle, and pray we move thereafter. Because the weekends lately, I mean, you might miss a big move over a weekend, but you know, you can't kick yourself for that, because the amount of time decay you're going to pay from a Friday to a Monday is not advantageous to what you're trying to do.
Yeah, well, last week was the first time that I didn't buy one over the weekend, and it was, sure enough, things went wild over the weekend, and we woke up Monday with a huge move. So I guess it's just, yeah, right. Yeah. All right, Don. Well, thank you very much.
Yeah, thank you. And we're heading up to the Northwest, man. If you want to make the drive up to Seattle later this week, Sosnoff and I will be up there later in the week. Up there is it June 2nd in downtown Seattle. But it's like a 3-hour drive from you, man.
Sounds great.
All right. Thanks again.
All right. Bye.
All right. So, as I was mentioning, Tom Sosnoff and myself will be heading up to Seattle for June 2nd. If you guys are listening, you're up in the Seattle area, shoot an email to Mary at ThinkorSwim.com, and she'll give you all the details in regards to the event up in Seattle. It's kind of a nice TD Ameritrade, kind of, you know, a little bit more of like a trader group event that it's always a good event. You know, it's Tom Sosnoff, myself, talking about the markets in general. Anyway, I think you guys should give us a call, 877-927-6648, if you really want to talk to us about anything in regards to stocks, options, futures. What's interesting is we just talked about options and futures and gamma scalping. So, you know, of all the different call-in shows I've done here on TFNN, this has been the most interesting one. We've had people talking about the VIX. We've had people talking about getting long and short volatility. The next caller basically was asking about portfolio enhancement. We've everything from negative gamma risk here to theta, the Greeks. I like it. Some of you listening, you're like, oh, I'm ready to hang myself listening to you. But, you know what? This stuff is a little bit out there, but, hey, you got to reach for it. But seriously, the Greeks are always what I call the final frontier for the retail client. It's like the one aspect that seems to never have permeated to retail clients is that a lot of professionals utilize the Greeks to be able to effectively mitigate, manage risk, and that never really permeates to a lot of retail clients. So with that, again, give us a call because, hey, there's a lot of time left and nothing to talk about. Give us a call, 877-927-6648. Actually, there's always a lot to talk about on here. In fact, take a look at the markets right now. So once again, NASDAQ futures are up 22. We're going to go in and talk about some specific underlyings. Priceline kind of, once again, kind of exploding through the highs here, up about almost $11 on the day. Another thing that I've actually been watching as of recently, and this is an underlying that I actually owned for quite some time, and finally have dumped it. Now I'm possibly looking at a short position, and that's Costco. So a lot of times in this show, I don't talk much about equities. I really don't. I have tendency to really key in and talk about major index products, Volatility, Vega, but then all of a sudden out of nowhere I pull out of a hat Costco. So why? Costco, it's at all-time recent highs over here. I'm a big contrarian, and I happened to pull up a chart on Costco just inadvertently earlier last week. I was talking to another trader, and he had mentioned on one of our chats on ThinkorSwim, he had mentioned Costco. So I started looking at Costco, and I'm thinking to myself, I'm like, wow, I've owned this stock in the past, took a quick look at it, and again, I'm not a big market technician. I'm a much bigger contrarian, much bigger tape reader. I take one look at Costco, and I looked at it again yesterday. Obviously, yesterday markets were closed. I was kind of getting ready for the week, and I took a look at Costco, and I'm thinking to myself, I was just in Costco on Sunday. And Sundays, it's one of the busiest days in Costco. It's absolutely brutal. I know it was a holiday weekend. There was nobody in Costco. And then I thought back, I'm like, previously to that, there was nobody in Costco before that. And I used to love that place. I'm just not loving it as much right now. So you might want to look at this as a possible short opportunity. But you know what? A lot of the rest of you guys look at this, you're like, oh, it's a perfect opportunity to enter into a long position. For those of you that are market technicians, this could be the the perfect head and shoulders pattern here. So again, I'm not a big market technician. But I enjoy once in a while taking the other side of the market, and that is taking a look at an underlying like this, possibly getting short. So, I pulled up a chart. I backed off just a few years out, and I wanted to look at, multiple year highs, multiple year lows. And I'll tell you what, we're there right now. Looking back 5 years, we are at the high in the last 5 years. Don't you wish you were long this underlying here for the last year? Because this thing took off from the 50 range all the way to where it is right now, 82.26. Again, possible short candidate here if you like that contrarian perspective. Anyway, I'm talking too much, and you guys aren't calling enough, so give me a call at 877-927-6648. Maybe we should come up with a few short ideas here in something like Costco. So I open up Costco. My trade tab in ThinkorSwim, I open up Costco, I take a look at the July options here. And, I hadn't looked at this prior to the show, the July options. There's not a ton of volatility in an underlying like Costco, major retailer out here. The July volatility is sitting at about, close to 22. The June options. So I just completely negated the June options here. There's only 17 days left. It's just, for most of you that utilize option strategies, you typically want to sell a little bit of juice, a little bit of time. A month is fine. Listen, if you want to trade weeklies, that's fine, but you're trading weeklies, you're trading short-term options, you got to stay on top of the position. When you sell something that's got 45 days to expiration, like this July option, all the time in the world to be wrong over here. So anyway, I look about one strike out of the money. I simply right-click, come up to sell, down a vertical, left-click and vertical. Here is an 82.5, 85 call spread on Costco for about $1.05 credit. Break-even point is, obviously 83.5. Probability, okay, so let's take a look at things like probability. Options, theoreticals, and Greeks going on to things like probability of expiring. The probability of making some money, break-even point, is about a 60-some-odd% probability of making some money in a trade like this. And that's based on some of our probability models, of course, on ThinkorSwim. But it's an interesting idea. Listen, maybe you're not bearish. Selling a call spread is absolutely bearish. Maybe you're bullish on here. Bullish on here, you could sell the 80.77.5 put spread there. It's all the same thing. All right, so with that, that's something I just wanted to bring up. Again, it's kind of rare that I talk about specific underlyings on this show, but this one is, one I've been kind of eyeballing here for like the last week. Came up again yesterday when I was glancing through some underlyings, talking about trades I was thinking about for this week. Anyway, with that, give us a call, 877-927-6648. How about this? If you've got an underlying, you want to get long or short, give me a call. Let's see if we can establish a couple of ideas for you in regards to some option trades. Or maybe you just want to get long the underlying, which is fine as well. Anyway, with that, it appears the market is now retracing to some of the highs of the day, which, if you're me right now, kind of sucks because I'm short. I'm always short. And if you guys have listened to this show pretty much since January when I took it over from Tom Sosnoff, I have been consistently short. So down days are typically good days. I like sitting with measurable short positions. I like sitting with long volatility, okay? And obviously down moves help me out a little bit. What's interesting today is, futures are obviously up on the day. The VIX was up on the day. The VIX is actually now completely flat on the day. We're pretty much holding right smack at a VIX of 16. Bonds, nominal move on the day. The only other mover on the day is, of course, oil back up about over $2. Even, SLV, silver. Silver was the talk of the town 2-3 weeks ago. What happened to it? Absolutely nothing. Okay, so silver on a daily basis here is losing some of its vol. So volatility, obviously, of silver now, that was up in the 60-70% range, has actually dropped down to about 48% here. It's, not too exciting anymore. So SLV was the trade. Volume is now dropping off as well. Don't worry, there's always a product to trade. With that, taking a look at some other trades here, it's a few other ideas. Give us a call, 877-927-6648. You guys are going to make me beg. In the next 10 minutes here, we can still answer quite a few questions in regards to some of your trades. Okay, so taking a look back over at the spiders, as I was mentioning just a moment ago, I happen to be to short the markets. And I said short in kind of a measurable fashion. What does that really mean? Whenever I talk about, being short markets, I get a lot of emails, a lot of calls, in regards to what that really means. Being short the market doesn't necessarily mean going out there and selling futures contracts short. It doesn't matter necessarily, how you get short. One thing that you have to understand is getting short stock, getting short futures leaves you with considerable risk out there, okay? I'm actually reading one of the chats in here. Can I look, all right, at FUL for long? I'll take a look at that in just a minute over here, but when people ask about, taking positions in the marketplace, getting long or getting short, what does that really mean to you? Getting long in the market doesn't mean necessarily going out there and buying shares. Getting short doesn't necessarily mean just selling shares of the spider short. Getting short is, in effect, okay, a process that takes, quite a long time. I go out and use some pretty standardized criteria. I like to sell options, okay, that I've got about a month in time, sell them between about a 30 to 40 delta. Okay, how do you do that? You simply right-click on the option, come down to sell, over to vertical. In this case, I'm selling a 136, maybe 138 short vertical spread here in the spiders for about a 72-cent credit. So selling the 136 calls, buying the 138 calls, yeah, this is a short call spread for July. Now look at some of the attributes of this particular trade. Number one, the spiders are currently at 134.31. Okay, spiders are 134, 131. I'm selling a 136, 138 spread. So how does this spread profit? First of all, you sell the spread for maybe a 72-cent credit. Okay, if the market stays flat, yeah, I'll make my 70 cents. If the market goes down, yeah, I make my 70 cents. Even if the market goes up to 136, okay, I still make my 70 cents. So this trade, one of the attributes of it, it's got some breathing room. Okay, this is definitely a short position, but you could be wrong and still make money. Ask yourself that question in regards to a lot of positions that you have on right now. Okay, and what's the question? Can you be wrong and still make money? So think about that on a day-to-day basis. On the trades that you have on right now, can you be wrong and still make money? All right? Because if the answer is, no, I have to be right to be able to make money, you have to realize that's putting a lot of odds, okay, against you in this business. This business is tough enough, okay? Put yourself into trades that you don't necessarily have to be right on and try to be profitable, and that's a good thing. But getting short isn't just about selling one vertical spread. Yeah, I sell a 136, 138 spread and I get short. Well, yeah, that's one trade, okay? But, getting short is a series of positions. So maybe you sell for some, in some instance, like 136, 138 spread. And lo and behold, we rally up and you still want to be a little bit short. So then you go out and sell a 137, maybe 139 spread. Okay, and that's after the market rallies up. Then before you know it, time has decayed a little bit here, and as time is decaying, maybe you're not using July options anymore. Maybe time decays. You've only got 30-some-odd days left in July, so maybe you start allocating a little bit of capital to August. Now you've got some short spreads in July, a couple of short spreads in August. You already had a few short spreads in June, and you're starting to actually build a short position staggered over multiple months and over multiple strike prices. And that, ultimately is what building a short position is really about. And again, it's not about utilizing one strategy. I just showed you getting short by selling some call spreads, all right? But also, I might want to get long some volatility, and that could be by means of buying out-of-the-money put calendars in a major index product like, again, the spiders. And I happen to have the spiders up on my screen show right now. And you can see the 131, strike in the spiders in July, and right-click on those and turn around and buy a calendar spread. And buy the 131s, sell the 131s for July, buying the 131s, for instance, September, gives you a little bit of long Vega exposure. And that, again, is kind of, in an instant, the building of positions rather than going out and just trying to say, ooh, I'm getting short the markets right now, getting down on your hands and knees and praying that everything works out, because it doesn't, all right? Again, to survive in this business in the long term, you got to put on positions strategically that work for you. And that's what a lot of people they don't really get about this. And I hate to go off and lecture, but you guys aren't calling in, so I got nothing better to do, right? No, but seriously, if you take a look at these positions here that I've created, they're all in conjunction with one another. I'm spreading out my risk over, again, multiple strikes and multiple expiration cycles. And when you start to build a position, they can get kind of intricate. You can have some July trades on, you got June trades on, you got August trades on, then you've got July, September trades on, July, August trades on, which are types of calendar spreads. Before you know it, you have so many different strikes covered. And then you start overlapping strikes, and you're like, oh no, I sold the 136s, and then I bought the 136s. I don't know what I have. And then one day you realize you're forced to read the Greeks. And reading the Greeks, once again, is the final frontier for retail clients. What the Greeks allow you to do is manage large aggregated positions in specific underlyings by looking at them all as one number in there. And that's just a cleaner, simpler way to be able to more effectively manage your risk and build positions. Now, lo and behold, a lot of you guys look at this and you're like, this stuff looks a little bit complicated here. Once you understand, building and managing inventory, and that's really what I'm talking about here. And if you guys know, on ThinkorSwim, you go to, the chat archives. There's tons of different chats that I've done over time in the chat archive in regards to building and managing inventory. Look them all up, building and analyzing trades. There's hours of archives built into ThinkorSwim, or, you can go to thinkorswim.com, and there's under support, you can literally go to Options School in the chat archive, type in my last name, Kaufman, K-A-U-F like Frank, M-A-N, and actually go through some of the archive, because seriously, it'll talk to you a little bit more about this. Now, it's not to say that this is it for trading, okay? You put on an inventory like this, and then on a day-to-day basis, I have tendency to scalp futures against my inventory, meaning that I'll buy and sell futures contracts against my major option inventory, try to be profitable on a day-to-day basis just purely on direction. And that's, makes it much more interesting for me, because there are days when I'm traveling around, I can't look at the screen but once and twice a day. There's other days where, like today, I'm sitting in front of the screen bell to bell today, you better believe that I'm trying to scalp some futures. And by the way, my scalping of futures today is really rather ineffective. I figured we'd sell off a little bit today. So I'm getting run over by a freight train right now on my my short NASDAQ futures here. Okay, but that short NASDAQ futures is against an option inventory that's actually bringing in theta, which is, of course, time decay in my favor. And to us, that's really what this business is about, is trying to generate trades that work for you. What you guys have to realize is a lot of you put on option strategies or just, trading strategies in general. Whether you use a stop order on a stock, a stop order on a future, it doesn't matter. But you guys put on trading strategies. A lot of you're right directionally, and you still lose money. And that's what, a lot of these sessions like this is about today, is really ultimately, again, putting on strategies that work for you. You don't necessarily have to be right, okay? Your directional bias, good, bad, or indifferent, does not necessarily make or break you in this industry. So with that, I will, of course, be back next week for the Option Hour. My name is Don Kaufman from ThinkorSwim from TD Ameritrade. Check out our software sometime. Check out, by the way, the iPad app. I am completely hooked on that one. Anyway, sounds good. On behalf of TD Ameritrade, ThinkorSwim, myself, have a great trading week, and I will talk to you guys early next week. Thanks a lot, everybody, and have a great day. Bye-bye.